Euro USD Weekly Technical and Fundamental Analysis for April 28 through May 2, 2025, brought to you by X&Y Trading. Welcome to X&Y Trading's comprehensive analysis of the Euro to US dollar currency pair for the trading week of April 28 to May 2, 2025. With over 27 years of experience navigating the complexities of global financial markets, our team is committed to providing traders and investors with clear, actionable insights grounded in both technical precision and deep fundamental understanding. As we approach a pivotal week packed with key economic releases and evolving market sentiment, we'll dissect the latest chart structures, price action signals, and volume dynamics, while also examining the macroeconomic forces and central bank decisions driving currency valuations. Whether you're a seasoned professional or developing your trading edge, our goal is to help you anticipate market movements, manage risk effectively, and capitalize on high-probability opportunities in the dynamic Euro to US dollar Forex landscape. Let's dive into this week's most critical technical levels and fundamental catalysts to equip you with the edge needed for informed decision-making. Let's start with the Euro to US dollar weekly chart. Since early March 2025, the Euro has staged a strong rally, with a major bullish impulse pushing price from below 1.07 to above 1.13. However, we're now seeing some rejection near 1.15734. The last two candles are smaller and show indecision, suggesting profit-taking or resistance at these higher levels. Volume flow and money flow profile show that the heaviest money flow is concentrated between 1.1364 and 1.1504, as seen in the volume profile histogram. This area acts as a key resistance and a magnet for price action. Above 1.15, volumes drop off, which could signal less buying interest if the pair breaks higher. There's a significant volume node around 1.096, highlighting strong historical accumulation and a potential support level if price retraces. Alright, let's talk about some key levels to keep an eye on. First up, 1.1573. This is the recent swing high, and it's acting as a major resistance. Then, between 1.1364 and 1.1504, we've got a high liquidity zone. You can expect some volatility here, and probably some range-bound price action as well. Moving down, 1.1294 is the next important support below the current price. And finally, the zone from 1.1015 to 1.096 is a strong support area with heavy accumulation. This is actually where the recent rally started. Now let's dig into buyers versus sellers contracts and the flow of money. The difference between buyers and sellers contracts is actually shrinking right now. Bulls are becoming less aggressive, which could be a sign of exhaustion. However, total money flow since January is still on the rise. Think of it kind of like a car that's still moving forward, but it's losing some acceleration. Looking at momentum indicators, the Chaikin money flow, or CMF, is probably elevated after those strong rallies, but it might start showing negative divergence if momentum fades. The RSI, or Relative Strength Index, was recently near or even above 70, which tells us the market's overbought and could be due for a pullback or maybe some sideways consolidation. And, when you start seeing smaller candles after a big run, that's often a sign that a retracement or at least a rest phase could be coming up. So, let's interpret the price action and volume flow. In the short term, bulls are still in control, but they're losing steam as we get closer to that 1.15 zone. For the medium term, unless something new shakes things up, we might see some choppy action between 1.13 and 1.15, or even a pullback toward 1.12 to 1.10, which would give buyers a chance to reload. But in the long term, as long as that 1.10 to 1.096 area holds up, the overall uptrend is still intact. Okay, so here's how I'd approach it. In a bullish scenario, I'd be looking for pullbacks to those high-volume support zones like 1.1294, or that range between 1.1015 and 1.096, for some dip buying opportunities. But don't forget, it's smart to wait for the CMF and RSI to reset before jumping back into any long trades. The real target here would be a break and close above 1.15, which could open up a run toward 1.1573 and even higher. Now, For the bearish scenario, if the price fails at 1.15 and closes below 1.1294, you should probably expect a deeper correction heading toward that 1.10 to 1.096 area. Also, keep an eye out for negative divergences in CMF or RSI. Those can be early warning signs that a reversal might be coming. When it comes to risk management, you definitely want to avoid chasing breakouts right into heavy resistance. Instead, try placing stops below the next support level if you're going long or above resistance if you're going short. Here's a quick summary. 1.1573 is major resistance, so watch out for failed breakouts or even a possible double top. The range between 1.1364 and 1.1504 is what I'd call a high-volume chop zone. Expect some ranging action there. 1.1294 is key support and could be a bounce zone if we get a pullback. And finally, that 1.1015 to 1.096 area is strong support, a major buy zone, honestly. Now let's zoom in a bit on the volume profile. There's still a lot of interest between 1.1364 and 1.1504. We're also seeing support clusters between 1.0945 and 1.1015, which means buyers have really been accumulating in that zone. So, if there's any pullback, I'd expect buyers to step in and defend this area. The ultimate support sits down at 1.0387 to 1.0578. If price ever drops that low, it's kind of a value buy zone, unless there's a major regime change, of course. As long as EUR/USD stays above 1.13, the bulls are in control. But if it loses that 1.13 to 1.12 zone, you should be ready for a quick test of 1.10 to 1.08. Below 1.0578, only a fundamental regime shift would justify it, but that would be a major dip buy opportunity, assuming the macro context hasn't flipped. So, switching to the daily chart, we see a recent trend that had a pretty sharp rally, but now it's stalling with these minor pullbacks and a couple of indecision candles. Volume-wise, there were big spikes during the rally, but now it's really drying up as the move stalls. This shows buyers are definitely less aggressive and there's more profit-taking or maybe even some seller activity kicking in. The CMF, or Chaikin money flow, is just slightly negative and hovering near zero after hitting a peak. This kind of divergence, well, it's a warning that smart money might be exiting, or at the very least enthusiasm is fading. Now looking at the RSI, it's at 62.14, so it's cooling off from overbought levels but still sitting above 60. That means momentum is fading, but it isn't quite bearish yet. In terms of market sentiment, the difference between buyers and sellers' contracts is shrinking. Aggressive buyers are pulling back, sellers are getting braver, and honestly the market is nearing a turning point. Overall, money flow is still rising, but it's definitely less aggressive up at these highs. Alright, let's talk about the daily trading plan. First off, don't chase longs here. Just wait for a deeper pullback or a bullish reversal off some major support. If the price holds above 1.1364, you want to look to buy dips. The ideal buy zone is somewhere between 1.13 and 1.12, but only with confirmation. If the price loses 1.13, expect corrections down to 1.12, 1.10, or even 1.096. And, watch for volume spikes on big red candles and a negative CMF. Those are definitely warning signs of a deeper pullback. Now let's look at the key fundamentals and economic events that could drive EUR/USD in the coming week. On the Federal Reserve or USD side, the Fed's stance on rate cuts is really the biggest driver for the US dollar. Right now, markets are pricing in fewer cuts in 2025 since US data has been pretty resilient. If Fed officials sound hawkish or if the data actually beats expectations, the US dollar tends to strengthen. Alright, let's take a look at the key data coming up. First, we've got the US first quarter GDP on April 30th, with forecasts pointing to a slowdown to 0.9%. If the data comes in weak, that could really put some pressure on the US dollar, but if it's strong, it might actually give the dollar some support. Next up, also on April 30th, is the US core PCE. The monthly forecast is 0.1%, with a year-over-year forecast of 2.6%. If this comes in lower than expected, it could weaken the US dollar. And finally, on May 2nd, we have the non-farm payrolls report. The forecast is for an increase of 150,000 jobs, with unemployment at 4.2%. If the data is strong, expect the US dollar to go up, but if it comes in weak, well, the dollar could go down. The European Central Bank is, expected to start cutting rates before the Federal Reserve, possibly as early as June. A dovish ECB usually means the euro is bearish. Here are some key things to watch. First, the Eurozone first quarter GDP on April 30th, modest expansion is expected there. If the data comes in stronger, that could actually support the euro. Then there's the flash inflation, the HICP on May 2nd, where continued easing is expected. Lower inflation supports the idea of ECB cuts and, well, that tends to weaken the euro. Finally, on May 2nd, the Eurozone unemployment rate, if it's stable or even improving, that would support the euro as well. Other influences like geopolitics in Ukraine and the Middle East, commodity prices and global risk sentiment will definitely play a role here. If US data beats expectations and the ECB stays dovish, EURUSD may break down through the 1.13 to 1.12 support area. But if US data disappoints, or the ECB signals caution on cuts, EURUSD could bounce up toward that 1.15 resistance. Now here's a quick look at the economic events calendar. On April 30th, US first quarter GDP is expected to show 0.9% annualized growth. Also on April 30th, the US Core PCE price index is forecast at 0.1% month-over-month and 2.6% year-over-year. The Eurozone's first quarter GDP, also April 30th, is expected to show modest expansion. On May 2nd, US non-farm payrolls are projected at plus 150,000 jobs with a 4.2% unemployment rate. Also on May 2nd, Eurozone flash inflation, or HICP, is expected to continue easing. And finally, the Eurozone unemployment rate for March will be announced on May 2nd. Thank you for joining X&Y Trading's professional analysis of EURUSD. Just remember, the big rally is showing signs of exhaustion and money flow is stalling, so you should expect sideways action or maybe even a pullback unless new catalysts emerge. Only buy if key support holds and the shake in money flow or volume confirm it. Sell or just stay flat if a breakdown comes with negative money flow and high sell volume. If you found this analysis helpful, please like, subscribe, and hit the notification bell for more expert insights. And don't forget to review our disclaimer and consult your own financial advisor before making any trading decisions. Good luck and happy trading. Don't forget to subscribe for more from X&Y Trading. Please review our disclaimer before making any investment decisions.